let's maybe talk about the new rates and, what people have to do when, these rates change.
So the nice thing is that if you're already getting a payment, you actually don't have to do anything. It's all automatic. And if you've been on one of our payments for a while, you'll be used to this. So what happens is that, as I said, on the 20th of March, 20th September, the government actually looks at 3 different indices to work out what the new pension rate would be. So there's the Consumer Price Index, a thing called the Pensioner and Beneficiary Living Cost Index. So if you like your letters, it's your PBLCI. So your CPI or your PBLCI. Now that Pensioner and Beneficiary Living Cost Index is actually just it's like a shopping trolley of particular goods and services that, if you like, would be essentials. Everybody has to pay them. Everyone has to buy them.
Particularly for pensioners?
Particularly aimed at pensioners, yeah. So luxuries would not be on that list, for example. And where the CPI is tracking the prices of pretty much everything, that is focusing on the prices of that particular list of goods and services.
Right.
And then they compare all of that with male total average weekly earnings, so a standard against, again, if we like our letters, Matawi. And whichever causes the biggest pension increase is the one that they use. And so what's happened on the 20th of September this year is that the pension has gone up. If you're a single person, the full rate of pension is now $1,178.70 a fortnight, which means it's gone up by $29.70 a fortnight. If you're a member of a couple, that's now $888.50 each, which means it's gone up by $22.40 each.
Now, these rates that you've just said and that are on the screen, they don't include like rent assistance or anything like that. That's just the rack rate. Is that correct?
They include the supplements.
Right.
So when we talk about a pension, what you get in your bank account might even just say, age pension or payment for services Australia. It's actually, we'll use the age pension as an example. It's actually an age pension plus there's a senior supplement and then there's an energy supplement. What you get is all of them put together.
Right.
So when we say that this is the increase, there is actually an indexed increase of all the supplements and increase of the pension itself, but that's the total picture that you're getting.
So let's talk about, what do we got here? Assessable income and assets, the changes. So they not only increase the payment rates, the asset limits also. And do the asset limits increase twice a year or change twice a year, or only the actual payment amounts?
No, so it's more than twice a year actually. So
right.
This is the power of maths. So when we increase the actual pension, what that does is it indexes, but pushes out by the way that our maths works, it pushes out the cutoff points for the pension. So the point where the pension is no longer payable, so there's an income cutoff point and an assets cutoff point. But separate to the 20th of March, so on the 20th of March and 20th of September, the rate of pension itself is indexed.
Right.
On the 1st of July, the income and assets points where they start going down. So the income and assets free areas, they also get indexed. So if you're getting a full rate of pension, the 1st of July means nothing to you because you keep getting the full rate of pension. But what it means is that on the 20th of March, 1st of July, 20th September, there is going to be potentially that increase in the income limits and the asset limits.
Yeah, so you could have ordinarily not on full pension, and you may get when the full pension rates that we've just discussed increase, no change to you, but when the asset limits increase, you may get a little bit more part pension?
If you're a part rate pensioner, all of these changes will mean that you'll get, if the pension rate goes up or the asset limits go up, means you're going to get more.
Yeah.
So with the income and asset free area, the amount of your assessable income and assets that we look at, we're going to ignore more than we were doing before, which means we're not counting as much as we were counting before, which means that there's going to be more of your income and assets that are ignored, which means your payment is automatically going to go up.
Yeah.
So if you're a part rate pensioner and the indexation does cause an increase in the limits, then you're going to notice an increase on the 20th of March, 1st of July, 20th September. If you're a full rate pensioner, you'll notice it only on the 20th of March and the 20th of September.
Yes.
So with the changes that we've just gone through, and there's quite a long list. So what we're going to focus on here is if you're basically a homeowner. because we've got non-homeowner statuses. We've also got rent assistance can make a difference to these limits. The full rate's on the website. So you go to servicesaustralia.gov.au, click on the panel on the front that best suits your circumstances. So there'll be ageing or disability and carers, for example. You'll get the full list of the new income and assets cutoff points there. But for now, if you're a single person who owns their own home, you're allowed to earn $960, I should say. So $66,960.40 per annum in assessable income and $714,500 in assessable assets before the pension stops being paid.
So a couple of things there. When you talk about homeowner, it's regardless whether you've got a mortgage or not.
Regardless of whether you've got a mortgage or not, yeah.
Yeah, okay.
So the first thing is that it's important to remember that for most people, if we are defining you as a homeowner, we are not counting the home in that assets limit.
Yes.
So when we're saying $714,500, for most people, that's apart from the value of the home and the surrounding 2 hectares.
And I guess the carve-out, and we'll probably get to this more, guys, in the next episode with the Q&A, but the carve-out there is if you did have an investment property with a mortgage, that mortgage would offset the value. Would it net out?
It can do. It depends on how you set up the mortgage. So that's
when you talk dirty to me.
Yeah. It's sometimes things are a little bit more complicated.
Right,
so it depends on how you've actually set up.
We'll revisit that next episode because I'm curious. So back to the cricket.
So mortgages on the family home, because the family home is an exempt asset, the mortgage on the family home makes no difference to how we look at things. If you're a member of a couple, so $714,500 for a single person. For a member of a couple, you're allowed to earn $102,284 in combined assessable income, plus $1,074,000 in combined assessable assets for the pension to be paid.
Right.
So another caveat on that one, that doesn't include work bonus.
Yeah, which we'll get to as well.
Which we're going to get to. So if some of the income that you're receiving that causes that $66,000 or the $102,000 is from wages or eligible self-employment, the work bonus makes those figures even higher. And again, it doesn't include the family home and it doesn't include things like rent assistance, which can push those figures up even higher as well.
Generally speaking, are people going to get caught out? And I think we probably should just actually explain the asset test and the income test. Or do you want to just explain that first?
Sure.
And then my question will be, what usually catches people first, the assets or the income?
Okay, so there is an amount of money that you can earn and there's an amount of money that you can own before your pension starts being affected. So if we want to go again for a single person, you can earn it's $218 a fortnight or $5,668 per annum where none of that income affects your pension.
Yes, okay.
When you earn over that, every dollar of income that you earn over that reduces your pension by 50 cents. For a member of a couple, that figure is $9,880 per annum in combined assessable income. If your assessable income is under that, then none of your assessable income affects your pension. And then again, for every dollar that you earn, it's 25 cents each, but the equivalent of 50 cents combined until eventually it reaches those cutoff points that we talked about.
Yes.
For the assets test, there again is an asset-free area. If you're a single person, that's $321,000 in assessable assets, where anything under that, the assets won't affect your rate of payment. And then for every $1,000 worth of assets that you have over that,
up to the $714.
Yeah, the pension goes down by $3 a fortnight until eventually, under the power of that maths, the pension can't be paid at $714. For a member of a couple who owns their own home, it's $481,500. Then the same concept, for every $1,000, it reduces the pension by $3 between the two of you until eventually it goes down to that $1,074,000. And at that point, the pension is zero. So it's a sliding scale.
Yeah.
There's a flat point where everybody gets the full rate. Then once you get over those limits, the more you have, the less pension you get, until eventually you get to the point where the pension can't be paid.
Yeah.
Now, most people are actually the full rate pensioners. So we know that about 66% of people getting the age pension are actually getting the full rate. So most people aren't affected by the income and assets test at all. Of the remainder, it's almost 50-50.
Right.
So if there's a general...
deeming knocks on the door.
Deeming knocks on the door for people that are income tested, for sure. Deeming really has no impact on the people that are assets tested, but it knocks on the door for people who are income tested because it's a source of assessable income.
Yeah.
But yeah, so there's a general thought that most people will be assets tested over income tested, but the reality is it's almost a 50-50 split. So it's very close between one or the other.
Yeah. Well, speaking of deeming, let's have a look now at the new deeming rules. Talk to us about the new rules.
Sure. So just quickly explain.
And potential changes and whatnot.
Yeah. Deeming, what it is.
Yeah.
So deeming is a set of rules where we determine a fixed income from what we call a financial asset. So for our perspective, a financial asset are things like your bank accounts, your share portfolio, managed investments, super if you're over age pension age. Most of your things like an account-based pensions are deemed. Also, if you've gifted money over the limits or if you've lent money to somebody. Now, in effect, we don't actually ask for using a term deposit, for example. If you apply for the age pension and you tell us you've got a term deposit, you're going to notice that we aren't actually asking what the interest rate of that term deposit is.
Because you don't care.
Because we don't care. We don't ask for most people what the drawdown rate for your account-based pension is because we don't care. We have a fixed interest rate that determines how much that's going to be. Now, what's happened, that fixed interest rate, it's really important to say that it is not linked to changes in the official interest rate. So deeming is a separate act and movements in deeming are dependent on whether the government decides deeming is going to change, not based on what's happened to the official interest rate.
So the deeming basically, I see it as, depending on your circumstances, really good for you or not as favourable, because whether you're in some high-risk investment and printing money that's higher than the deeming rate, awesome. Or the other side of it just levels the playing field for, again, you don't care if it's a 5% interest rate of the account or a bonus 5.5 of the month or 4%. So it's just a blunt leveler.
It is from that perspective. And there is
But if there was an investment that did well and produced all this income, the chickens will eventually come home to roost anyway because you've got that extra capital in your life.
If you're not spending it, yes. So you're building up your savings and that eventually moves things through.
Yeah.
So when the pandemic hit, the deeming interest rates were set. Now, there are two stages. There are two levels. The lower level was set at 0.25% and then the upper level was set at 2.25%. Now, on the 20th September, what the government did was they came along and said, oh, look, that's not really reflective of what's actually happening out in the market. It's now time to actually start moving deeming to reflect what's really going on in the market. And so they increased those deeming rates. So the lower level of 0.25% has now become 0.75%. And their upper level, which is 2.25%, is now 2.75%. So they've increased it by 0.5% on both parts. Now, if you are a single person, the first $64,200 that you have is deemed at that 0.75%. Everything over that is deemed at 2.75%. As a member of a couple, that's $106,000 up to $106,000 at 0.75, and then over that 2.75. So what we do in effect is we take all of those financial assets, we add them all together, we come up with a lump sum, and then we apply those deeming calculations to that.
Now, you know, by Nature Services Australia, it's their whatever party's in government. There was, I think, was it one of the federal budgets, they extended the lower COVID deeming rates. Are you saying with these changes, we're now back to normal pre-COVID-ish, or is it still lower than pre-COVID?
Look, deeming moves all over the place.
Right.
So there's been times in the past where you would be...
Because they halved it during COVID.
They really brought it down and they kept it down.
Yeah.
So,
but that's kind of, that era is gone is what I'm saying.
Yeah.
Yeah.
So whether it's the pre-COVID rate or not, it really depends on what the market is doing. So it's again, it's not linked to the market, but it is going to be a reflection. So if you're using something like a bank account, for example, there's absolutely been time over the last few years, and there is time now, where you'll be able to get through just a simple bank account interest rates that are better than deeming. There's no guarantee that's going to be the way it's going to be ongoing. Yeah. But one of the reasons I like deeming is one of the things that you've already mentioned. It's the benefits of it, first of all, is that because we have got this deeming rate, you don't need to tell us about your investment income changes.
So it just saves all that extra collecting of information.
Yes. Yeah. So
because markets fluctuate daily, weekly.
Yes. So things like dividends from your share portfolio. So the only reason that you tell us about receiving dividends from your shares is if your bank balance actually significantly changed. Not because it was a dividend, but just simply my bank
That's what I
account's
said.
changed.
Well, like the capital's increased,
Yes.
so all the chickens will always come home to roost.
Yeah.
Yeah.
But again, if that money is taken and spent, then nothing hits your bank account, there'll be no change. For term deposits, yes, you tell us that you've changed term deposits, but again, we don't care what the interest rate is. From your account-based pensions, we want to know the balances, but we actually aren't asking for the interest rates for those.
Yeah.
Because they're deemed. Now, so the first thing, it's just easier from that perspective because we have our interest rates. We don't need you to tell us about changes in your income. The second one is the one that you've already got to. If you choose to draw or get an investment that pays better than deeming, it makes no difference from your rate of perspective, from an income perspective, as if you chose to do one that does nothing. So if you choose to put all the money into the mattress because you don't want to have anything to do with the bank, it's going to affect you exactly the same as if you put it into some form of managed investment that gave you 7%, or you chose to draw down, 12% from an account-based pension. We're going to treat them all exactly the same. So if you get a higher level of income than we deem, well done.
Yeah.
That is just money in your pocket with
But
no
you
effect on
should
pension
spend it
eligibility.
or it will catch you.
Always remember that.
Or give it to me.
Well, that's a gift, so that way. Always remember that with higher levels of return, there's the higher levels of risk associated with getting those higher levels of return. But the other thing that I really like about deeming is it's that leveling concept that you thought. So in the past, a lot of people would be choosing their retirement investment assets based on whether it was Centrelink friendly or not. So I'm going to, not based on whether it's good for me, whether it's good for long-term planning, but whether it's better for the rate of pension I'm getting or not. Deeming actually stops that from happening.
Yeah, and I was going to say it earlier, like when we talk about Centrelink benefits and age pension, and there is that mindset that I've paid tax all my life and I deserve to get age pension. My whole thing is build wealth, look after future you, and if you generate enough wealth to not need the age pension or any safety nets and all that, awesome. But with various strategies, you can legally structure things in a way that you might be able to optimize and get $2 pension a fortnight to activate the other benefits, and you'll do that all day long. But I don't think it's the old cutting off your nose to spite your face. Well, let's spend $500,000 before we get to age 67 so we get the full pension in 3-5 years. What are we doing here?
Yeah, so the real concern is doing something like that means that it's great, I got a pension sooner, but what does that mean in 10, 15, 20 years when I don't have those assets any longer? So the advantage of having wealth in retirement is choices and options. The less you have, the less choices and options you have.
And last time I thought about it, when it comes to money, more is more.
That hasn't changed.
We'll be back right after this, and we're going to talk about concessions. Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.